Yeah. So I'll just introduce Mr. Khalid Al-Noor. Khalid is a renowned financial expert. He is a CFO. He take care of the financial planning aligned to the strategy, helping many organizations to streamline financial processes. Okay, so his best experience now he is helping organizations to streamline financial processes from the strategy point of view. So welcome, Mr. Khalid Noor, to join the conference. Please share your insights. Maybe you can briefly introduce yourself. Thank you.
Thank you, Sheikh Abdul Qadir. I think that today's day was fantastic. Can you see me or can you hear me? All right?
Yeah, we can hear you. Yeah.
Can you see my picture as well?
Yes, we can see you.
Right, because I can only see my screen, my presentation.
You're still looking after so many hours, you're still looking fresh. Okay, so thank you.
I managed to take some breaks.
Yeah.
No, today's session has been very powerful. I think great lineup of speakers. I feel a bit humbled to speak on this very esteemed platform that you have created. I think it's a wonderful effort. So a lot of learning today. So I won't go through my introduction, just showing you the flow of the presentation today, that introduction to strategic financial planning, also looking at the strategy and the finance strategy. So representing finance today amongst the strategy practitioners, we just heard Salman on budgeting, and before that, Samir. Alignment with corporate and business strategic priorities. Some of the key assumptions that we use in strategic financial assumptions. The criteria, very important criteria for resource allocation to the strategic priorities. How do you actually select these strategic priorities? What are the key resources that we invest in? Touching upon risk management, ring fencing of resources for strategic projects, and also tracking spends versus outcome, and a little bit about the 5-year plan, the financial statements that we use, the income statement, the balance sheet, and the cash flow, which is very important. So let's, and I'll also share some of my experiences at Unilever and Novartis as to how they are doing their strategic plan. Okay, so what is strategic financial process? So it is all about, it's a comprehensive process that achieves the long-term business objectives and financial goals. It is a dynamic and ongoing process and involves making decisions across all steps of strategy management. It used to be in olden days, it used to be the strategy document would be revised every 2 years at Unilever. But nowadays, with the world changing so fast, most recently is that we have to do a quarterly review of our strategic plan. This has put in a lot of pressure. So unless we have the right systems and processes, it's going to be very cumbersome. Any help for a good strategy documentation system and analysis system would be very helpful. And I see that True Strategy has got a lot of facilities that one can explore. So when doing financial analysis, we have to look at company's current position. We have to look at how our financial plans align to the goals and objectives of the organization. And also in the introduction, we have to talk about the allocation of resources to strategic priorities and manage business risk and achieve long-term financial stability, or sustainability is the key word these days. So coming to Unilever, Unilever is a FMCG company, and it has a lot of broad range. It's a very big company, one of the biggest FMCG company in the world. It has got a lot of categories like the personal care, the home care, the beverages, and food business. So the strategic planning process starts with the category plan and at the global level, and this is cascaded down to country level and region level. Then you have brand plans like brands like Lux, Dove, Sunsilk, Surf, Lipton, and Brook Bond. These are global brands. So each brand is supporting the category that they are in. And then we have a business unit plan. So this is like an overarch. It's like for food business, there will be a business unit head. And for the home and personal care, there will be a business unit head. So we have a country plan, we have a region plan, and we have a global plan, just like any other multinational company. One of my boss, a finance director from India, actually came to visit Pakistan, and then he gave this golden lesson to all the finance community that sales is vanity, meaning that top line growth, market share at any expense, it's vanity. We all like to be number one and number two. And that's what Unilever says also, that their brands have to be number one and number two. But then profit has to be sanity, and ultimately cash is the reality. So this is the underlying principle for all finance, that although top line is good, but equally important is profit. And ultimately, companies that go bust is because they run out of cash. So cash we have to manage. So we will talk about the three statements that they are integrated even in the 5-year plan. Previously, it used to be only P&L or the income statement, but nowadays it has to be an integrated balance sheet as well as cash flow to really understand how much is the capex requirement, how much is the working capital requirement, and whether we run out of cash or not. So the second principle, again, learned from Unilever. My slide is not going. Yeah. And this is very interesting. You can get away with murder as long as your margins are right. Now, this is very interesting. The brand value or the intrinsic value of the brand depends upon the health of the brand, and the health of the brand depends upon the margins of the brand. So the stronger the margins, the stronger the brand. It does depend whether the brand is in a luxury segment or it's in everyday needs segment, because the margin strategy will depend on the luxury brands will have a higher brand margins, whereas a everyday item like a detergent powder will have a much lower margin. Globally, FMCG companies are trying to get away from low margin business. So Unilever has diversified their oil and dairy fat business. They got out of it, and then they also got out of the loose tea brands. So the packet tea that you get, so they've recently moved out of that. So commodity business, which are very volatile sometimes, and they, although very high volume, it's very low margin. So they want to focus on a very high margin. Again, in my one before, the company I used to work at, Novartis, a totally different company, a pharmaceutical company. Here, the strategic planning process is very, very different. They look at the global disease burden study done by WHO. They look at their own R&D pipeline. They look at the global patient demographics. They look at the reimbursement policy because it differs globally. So those which are insurance-based reimbursement, like in the US and in Europe, the reimbursement policy actually they launch their brands first in those markets, and then where self-pay market like in subcontinent and in Pakistan, Bangladesh, and Sri Lanka countries where you have to pay out of pocket. These expensive brands are come in later. So they have a global launch plan. They do a plan by therapeutic, by disease area. They do planning by region and country plans. Coming to the strategic planning and analysis, so in the strategy management cycle that we have been witnessing today, starting from EHI, that we first look at the current situation, we look at the setting goals and objectives, we formulate strategy, we do strategic planning and go into the strategic execution, and then again the loop goes on. So in each area, we have strategic financial planning is required. So for example, in looking at the current situation, we look at the past 5-year financial performance. We look at the external and internal analysis, like Pestle, do SWOT analysis and capability gap analysis, etc. So in every step, the finance is involved so that we provide the right information for decision making. Similarly, when we are setting goals and objectives, we want to evaluate new products and services. We want to benchmark target setting for market share. And also linked with that is profitability and liquidity. So these are some of the financial objectives and business objectives that we need to set at this stage. And financial evaluation and financial planning is required at this stage also. Coming to the strategy formulation, when we are looking at making strategic choices, we have to do project feasibility. And along with the strategic choices, we have to look at the HR strategy, filling in the capability gaps, supply chain strategy, where we have to do CapEx to meet certain gaps in manufacturing facility. Increasingly, now we have to look at digital strategies so that our business model based on technology available and AIs of the world, we have to account for that. And then, of course, finance strategy comes in, and we try and make a cohesive strategy map out of that. And we've seen some examples of strategy map today. In terms of strategic planning, these are both operational plans for individual functions as well as financial plans, which are both short-term, medium-term, long-term, and involves resource allocation to the strategic priorities. Then comes the strategy execution, and we have talked about today, is getting the right talent for the right position, and finance resource and allocating financial resources, and looking at the and also make a balanced scorecard to ensure that we are able to review our progress in terms of strategy execution. So as you can see that throughout the strategy cycle, the financial evaluation and financial planning and analysis is a must. And therefore, companies like Unilever and other global companies have created a position called finance business partners. And these finance business partners actually report into the marketing or the business unit head. And they are like mini CFOs working for each business unit. And therefore bridging the gap between finance and marketing, and also that the finance is able to have a better understanding of the business and its priorities and its customer pain points, for example. So they are better able to do financial planning for their individual business units. And when it comes to presenting it to corporate, the finance business partner is, along with the business unit head, is able to explain the strategy as well as the investments required in their business. So for example, in Pakistan, when they launched the ice cream business, Walls, one of the biggest growth driver was having ice cream freezers across the country. And it was a huge investment. So a phase-wise investment plan was put in place, appointing distributor network, and approximately 100,000 plus freezers were placed in the shops across the country. And with each, and they were monitoring the sales throughput of each ice cream cabinet, and just to ensure that they are productive. Okay, so the strategic financial plan is not a plan in isolation. It is actually a confluence of all the organization strategy. So as we see that, starting with the corporate strategy, the marketing strategy, sales strategy, the supply chain strategy, the R&D and innovation investments that we put, the talent, and the organization strategy. They all are put in and are taken into account in when we are constructing a strategic financial plan. So when we are looking at a time horizon, we're looking at the operational budget. The time horizon is generally 1 year. Then we are in the stage 2, we're looking at 1 year plus some quarterly multiple. For example, in rolling forecast, we use 8 quarters rolling forecast. So it is 1 year plus another 4 quarters. So this is also more operational nature. But when you come to 2 to 3 years integrated financial planning, so there is an element of strategy in there where you're looking slightly longer term. And when you're looking at 3 to 10 years, it is incorporating all the strategic priorities and strategic action that is required to take the organization to the vision and the mission, the purpose of the organization. So it is important that we look at each operational planning and the integrated strategic financial planning in its perspective. The operational plan or the budget would be far more tactical and operational in nature, whereas a 2 to 3 years or 3 to 10 years budget will have elements aligned with the corporate strategy. So what are the key investments that is required to execute those big changes, a big transformation that is required, has to be clearly articulated in those financial statements. So when we are doing financial analysis, some of the basic questions that we ask: is the current growth curve sustainable? So there is a growth curve. We have to see whether we are in the growth path, or are we plateauing, are we declining. So we need to understand the growth curve, and it can be based on the life cycle of the brand, when was it launched, and so on. The other questions are the profit margins. That's very important for the business viability and business health. Then we look at the utilization of the assets. What kind of efficiency these assets are being used at? What kind of capacity utilization are we doing? If we are near capacity, then we need to invest in further capacity expansion. And similarly, if we are underutilizing these assets, then we must find ways and means to utilize these underused capacity. Also, we need to look at the operational cash flow, whether the business is able to create sufficient operating cash flow. And there we need to balance our capex requirement as well as working capital. And we may need to tweak the working capital policies so that the investment in working capital is aligned with the liquidity requirements. For example, this inventory may be currently at 90 days. So if we can cut it down to 60 days, we are able to release a lot of cash. Same goes with customers' terms and vendor payable terms. I remember that in Unilever, we were importing a lot of teas from Kenya and Indonesia, and also palm oil. And I think the term was 60 days. One of our new commercial directors or finance director came in and said, the financing cost in internationally is much, much lower. And why can't we increase the term without really affecting the cost? And we managed to, from 60 days, we managed to get the terms to 180 days. And we had a negative working capital, which was fantastic because it gave us so much cash that we could invest in the ice cream business. Actually, we didn't have to raise any capital or take any debt, just a working capital adjustment, working capital management released cash. So it's very important for our team in the operations and in the sales and in procurement that they should understand that their policy, how they affect the working capital. Also, when we are doing financial analysis, we have to look through the life cycle, whether we are in a startup phase, where there is a huge investment in acquiring customers, and we may be in negative at that moment. Then we have the growth phase where we are expanding quickly, and there's a lot of investment required in both people and capacity, and as well as working capital. In maturity, there we have to see how we manage and retain the profit, manage the profitability. Generally, it's a cash-driven business, and therefore we just have to manage the profitability of a mature business before we actually decide to diversify. So, so why is strategic financial planning so important? And the whole idea is that we want to achieve the strategic goals and objectives. We want to make informed decision-making about capital allocation and risk management. We want to improve our financial performance. And also, we want to attract and retain investors. This is very important. When you are growing, you need to retain investors, you need to attract investors so that the business is able to raise equity capital as well as debt capital. So it's quite important how we sell the story, the finance story, to our investors. Then also, it's all about risk management and mitigation, as well as overall financial performance of the organization. So this is why we want to do financial planning, is to ensure that the business is sustainable, it's healthy, and it's able to generate cash to meet business expenses. Some of the key assumptions that we use in financial planning are external indicators such as the economic growth rates, the interest rates, inflation rates, and where the business is dependent upon overseas customers, as well as imports, and exchange rates play an important role. The industry growth projections, the competitive dynamics, as well as the internal capability gaps. So these are some of the factors that you have to start building into your financial planning assumptions when you are making it. The core element of finance strategy is the capital structure as to what is the optimal mix of debt and equity financing. Debt is generally cheaper than equity, but then you can only take so much debt, and the business acquires a mix of both debt and equity. Cost of capital is very important to understand. What is the cost of raising capital from different sources? Capital allocation, and this is we are going to talk about shortly as to how we allocate or rank different projects for investment. For risk management is core in finance. When we are doing financial planning, we look at various scenarios as to what's the worst case, what's the best case, and what's the most likely case. Then we look at the performance measurement, and these are some of the KPIs that we use, as discussed earlier, like sales growth and profit margin and cash generated. So some of the financial objectives that we are concerned about when we are doing the financial planning are, of course, profitability. We want to maximize the net income or earning per share, or we benchmark in the industry. What is the profitability benchmark? And then we try and at least exceed or meet that profitability benchmark. We want to look at the growth, liquidity, both efficiency and the solvency of the business. long term. So alignment we've been talking about, I think there was Alex actually talked about alignment a lot today. And that is fundamental when we are doing financial planning. It's a fundamental that we align our financial budgets with corporate and business strategic priorities. And also all the rest of the plans has to be aligned with the business strategic priorities. So the sales, HR, R&D, and our geographical expansion plans and all our operations plan, first they need to be aligned with the strategic priorities, and then the financial plan that comes out also needs to not only at the highest level, but also with individual functional plan. It has to align with that because each function will require different level of investments. For example, HR needs to hire a team of new sales team for a new launch. So we need to take into account the additional headcount there. So in terms of resource allocation for strategic priorities, this is very, very important. And as to how we actually go about choosing or ranking our articles, our investment priorities, and how we choose those projects. So as discussed today, there could be so many choices, there could be so many options. And Mihai today showed a palette of the Penta model, whereby the options, the strategic choices were quite a huge number of strategic choices are open to an organization. So some of the allocation criteria is the strategic alignment, the return on investment, and risk assessment. We also have to look at the time horizon as to whether the project is short-term or long-term, and also look whether the project is flexible enough in terms of adapting resource allocation to the changing market conditions and priorities. So I'll just show you an example that I did most recently. There were quite a few projects, so I've just given them a code, project A, B, C, D, E, F, G. And the top part is the financial attractiveness, and the second box at the bottom is the other non-financial factors. So you can see that we look at the initial cost, we look at NPV, the net present value, we look at the IRR, the internal rate of return, and the payback period. And we assign weightage to each one of them and come up. So overall it comes to 100%. And we assign, so this is the initial cost. So you give them, you rank them in a table of 1 to 5 individually, and then you calculate the weighted average here. So this is, so for example, project A is 4, project C is also 4, and project D is most attractive at 4.3. So I've taken the weight, these ranking here and put them in the financial attractiveness row over here. So, and also the other elements like strategic fit, export potential, technical difficulty, access to material, and their weightage has been assigned. These are subjective, and after consensus with the top management as to what weight should be assigning, and we are putting these weights here. So, for example, in project A has got a good strategic fit and therefore has got the maximum score. Similarly, export potential of project C is very attractive, and so on. So access to raw material, again, project C is most attractive. So using the weightage, we come to a weighted average ranking of 4.1, 3.8, 3.9, 2.9, so on. And the project ranking comes in here. So the project A is number 1, project C is number 2, project B is number 3, and so on. Project D is number 4. So this is one way, and this is subjective. This is has to be aligned with the top management, and it can take a few iterations before you come to a conclusion, and even then you may try and change the variables to better to make the decision much more relevant. So these are not fixed. This can depend on the industry or the nature of the business at a certain point in time. Some of the key business resources that we would be investing in our financial planning would, of course, be people, brand development, advertising, social media, also R&D, and how do we create an organization that foster an agile and efficient organization structure, and which is performance driven. For example, we have to invest in standardized processes that we talked about in systems, which can make the overall company much more agile and efficient and give our customers a good experience. So while making a financial budget, we need to take into account these investment areas. And these would come from our capability gap or gap analysis that Mihai earlier talked about in our very first lecture today. Now, the other part of business risk management. So this is part of the financial planning that we need to understand what are the underlying risks. We need to assess those risks and also see what kind of strategies we need to develop to reduce the likelihood or impact. So risk mitigation steps is required along with the financial planning, and also do, as I said earlier, that we need to create scenarios, various scenarios, and these could be the best case scenario, the worst case scenario, and most likely, and this can take into account various factors, for example, a pandemic or exchange fluctuation or inability of our major vendor to supply. So those kind of factors can be built in, and also a mitigating factor could be also put in that will help the business to navigate through any major crisis that comes through. So a business continuity plan, for example, is a good risk mitigation plan. This is very important when it comes to strategic finance planning, that we need to really ring fence resources for strategic project. This is very important. Otherwise, those projects will not be executed. So we need to ensure that these initiatives receive necessary funding and support, and we need to track them, that these funds are adequately available, and they are actually separated from the main budget, so that we can actually track them. So we talked about monitoring, tracking. So there is a quarterly review plan is recommended, whereby we are looking at the progress that our financial plans are still aligned with the strategic objective, that we are tracking the actual spend on important projects. And we also need to assess the outcomes, whether these outcomes are as per plan, or there is some adjustment required in our strategy. I'll skip this section. Debt is cheaper and equity is more expensive, but then there are some advantages to equity, that there is no fixed financial cost and there's no obligation to repay, but it does dilute ownership and control and has a higher cost because there is some issue. The interest payments are tax deductible, whereas dividends are not. And this creates a huge disparity, although both are investors in the business, but then it has produced disparity and made debt more attractive as a source of financing. I just want to touch upon, and I believe Samir or Salman actually touched upon the business model. It is so important for finance people to understand the business model. It puts in so much clarity as to who are the key partners, what are our key activities, what key resources are required, what is the corporate value customer value proposition, how we are building relationship with our customers, what are our key channels, what are our key segments, what is our overall cost structure, and what are our revenue streams. So you can see that the overall revenues, an estimate $100 million, for example, and this is broken down into customers and key channels. And we are investing like 20 million in building customer relationship here, and the overall profit that the value or the margin that the business is able to generate is 100 minus 80 million is 20 million, showing in the value proposition in the center. And the cost structure is broken down between cost activities and key resources. So 60 million going to the key activities of sales, marketing, supply chain, R&D, etc., and key resources, 20 million. So the idea is that we need to assign value into the business model, which makes it a very, very powerful tool to understand the business strategy. I find the business model is as incredible a reflection of our strategic decisions reflected on one page. It's very, very powerful. We just talked about the value chain also in a previous session. And again, you can actually assign values in the value chain to understand where we are putting our financial resources, which activities are taking most resources, and whether we are getting value from those resources or not. There's a lot of insourcing and outsourcing decisions that can be based on the value chain analysis. So, for example, logistics is generally outsourced. Now, lastly, we're coming to the integrated financial statements. So, in terms of income, the three famous financial statements are income statement, balance sheet, and cash flow. So the income statement is for a period, for like a quarter or for a year. Balance sheet is at one particular point of time, and cash flow matches with the same period as the income statement and shows the changes in cash over a period. Now, they are all interlinked. So when we are doing the financial planning, the planning horizon is generally 3 to 5 years. So you can look at revenue, you can look at the cost trends, you can look at the fixed costs, which are in the operating cost, and the overhead expenses that you see that these are of a more of a fixed nature and they are increasing over a period. This could be the additional headcounts that we need to hire to support the business that is growing. So there's a lot of factors that we need to consider when we're doing revenue forecasting. So this could be both units, pricing, channels, and geography, and new markets, new products, etc. So generally, the costing and the FP&A department in finance are very good at it, and they are able to compute the financial projections. But we as business leaders need to really understand whether the business is going to be making money. So in terms of gross profit, whether the margins are being maintained or not. This one is not showing the margins, but even in absolute terms, whether the growth in gross profit is aligned with the profit growth or in revenue growth or not. So here we are actually looking at the trends and seeing if there is any exception, and these exception could be because some major investment that we are undertaking. We can also look at so each line needs a separate analysis, whether the interest expenses make sense. If the business is able to generate enough cash, then we should not be seeing an increase in interest expense. Similarly, income taxes has to have some kind of relationship with the EBIT. So here we see that there is some issue, that the EBIT is 954 and the income tax is 89, so it is in line. So income before tax is in line with the EBIT, of course. So there has to be a good overview, and so the FP&A manager along with CFO actually does a detailed review, and they are looking at both the trend as well as relationship between each other. So the revenue has to match with the cost of goods sold, and the gross profit also has to match with the set parameters. So generally, target gross profit margin is assigned. Let's go to the next statement, which is balance sheet. The balance sheet is actually called balance sheet because it is the total assets and the total equity and liabilities actually balanced. So you can see that 2.6 billion is equal to 2.6 billion here. This is a snapshot at the end of an accounting period, could be end of the year. So at the end of year one, the total assets were valued 2.6 billion, for example, and they were financed by equity by 858 million. Also, there is long-term liabilities, and there are also short-term liabilities. So overall, the financing is done by three components: equity and debt and current liabilities. And here also you can see a trend that the fixed assets is growing as the business is growing, 440, 525, and 785. So the finance people have to actually see whether these kind of addition capex is actually justified, and they would be looking at the capacity utilization when looking at the capex requirements. Some of them could be, and this is at the net book value, so meaning after depreciation charge. So, and adding capex. So some of the capex could be replacement, and some of them could be giving additional capacity required. Current assets are generally working capital, and is quite a big number that is being generated here. It's kind of doubled from year one to year five, and we can look at the revenue, whether this. So here we see a problem that revenue is increasing by like 50%, whereas the working capital is increasing by 100%. So here again, we need to look at the working capital policies and tweak them so that we are able to reduce the exposure to such a large working capital investment. Again, equity increase is generally the profit retained in the business. So we can see that the business has been healthy and the equity has been growing. So this simple model hasn't taken into account any dividend paid out, but dividend is generally paid out like up to 40 to 50% of the income could be paid out, and depending on the stage of the business, in initial stages of the business, 100% of the profit is retained and reinvested in the business. But as the business grows and goes into maturity phase, most of the retained earning is either distributed. This is cash flow. Again, it's similar to income statement. Here we are seeing the cash flow from operating activities. Then we are adding some non-cash items like depreciation and amortization is added back. There are certain working capital movement and changes in short-term liabilities. So this is summing up to 370, 376. So overall, because we are investing a lot in our working capital, there is so the cash from operating activities is less than the profit, and this is very important. We saw that the profit is sanity, but cash is reality. So if you look at the net income, it's in the region of 550, 598, 600, 700, whereas the cash generated is in the region of 370, 376. So there is quite a shortfall from profit after tax. And the main elements which is creating this negative is the working capital change. So the inventory is increasing by 89, 113, 137, 166, and 200. And similarly, the receivables are increasing. So this is actually creating a negative, increasing working capital is creating a negative cash outflow. Then we look at, so this is cash from investing. So investing activities mostly would be in the fixed assets, in the factory or some other assets. So 75, 150, 200, etc. And again, if we are taking in some financing, for example, some additional resources, so these will be added to our cash. And then the net cash flow is calculated as 495, 426, etc. And we have a beginning cash balance and a closing cash balance. So you can see that the business over a period of time has able to generate 2.7 billion of cash. And this allows us to come to discuss the dividend policy of the organization as to how these earnings or the cash is utilized. So unless there is a major strategic investment opportunity that comes around, like an acquisition, for example. This is a very, very important document to understand. So I would encourage all functions from other than finances to not only look at the income statement, but they should also look at their impact of the business decision or the policy on the balance sheet as well as on the cash flow. This is a summary of what's the working capital days are like. So for example, days inventory, 23 days, it's gradually going up, 23, 25, 27, 30, and 33. And that is why the inventory is increasing. Similarly, the receivables, days sales outstanding is also increasing, 16, 18, 19, 21, 24. The days payable is actually decreasing. So we are paying our vendors early, 37, 33, 30. And that's why it's creating a negative working capital. These are other short-term liabilities, and here we see an increase. So overall, if we have what we call CCC is the cash conversion cycle, it means that we are able to convert cash back in. So if we invest today, we'll be able to return our cash in 47 days. Here, 44 days, 42 days, 40 days, and 39 days. So although it is actually reducing, but our net working capital is actually increasing significantly from the net working capital, starting net working capital 183, 455, 780, 1. So it shows that there is a huge element that requires a correction in this assumption. So we have to go back to marketing and discuss about the customer trends that from 16 days, we are increasing it to 24 days. And what is the underlying factor? Similarly, in terms of DPO, why are we paying too early? Why can't we negotiate a better credit term? As the company is growing, the business will be also growing. So these are some of the very important factors, that indicators that can really help the organization create value through reducing their net working capital. These are some of the standard ratio analysis, where we look at the profitability ratios, gross margin, net margin, EBIT margin, EBITDA margin, return on assets. And here we can see, although the gross margin has been kept constant, which really, this is an example, but in reality, the business should strive to improve the gross margin, because that really creates a lot of value. And increasing the gross margin will also help improve your net margin and all other margins. The return on assets is alarming, because it is actually declining. And this is once, as we saw that the assets, especially the working capital, was increasing, it has put it is actually lowering the return on assets. Return on equity similarly has gone down. So we need to address both the asset side as well as equity. Equity, as we were not distributing and accumulating in the business, and the equity was building up, whereas the profit was not increasing to that extent. So the return on equity has actually declined quite significantly, and this is not acceptable. In terms of liquidity ratios, the current ratio, starting with 1.6, is improving year on year, and that is showing that our current assets are increasing significantly versus the current liability. And that's, although it's improving, but then it also shows that we are tying up a lot of our capital in working capital, and that is not efficient. The quick ratio is also showing an increasing trend. The quick ratio is current asset minus the inventory. So it will include mainly your receivables. So receivables divided by the current liability. And this is also, although it's showing that it is increasing, again, it's not a healthy sign, because your receivables are increasing. Your net working capital ratio to the sales, for example, again, starting from 8% has gone up to 24%. This is something which needs to be remediated. This kind of investment in working capital is inefficient, and therefore, as I said, that some of the commodity-based business like tea and edible oil business actually work on a negative working capital, which releases a lot of cash. Solvency ratio is debt and equity ratio, and here we can see that equity over a period has increased from 33 to 56%, and debt from 67% has gone down to 44%. We can look at some of the efficiency ratios. The asset turnover has actually declined because we saw an increase in the asset. Fixed assets turnover is also declining. The account receivable is also declining. So these should give an alarm to both the FP&A team as well as to the supply chain and operations team, as to really understand what is driving the efficiency ratios negatively. Similarly, the inventory turnover is going down. So, which is showing a buildup of inventory. So these are some, when we are doing the strategic financial analysis, this really helps the ratio analysis to throw out. And as we discussed in some of our presentation, the AI will be able to pick up and actually throw out and maybe even do a recommendation that some policies needs to be changed. So we look forward to the new generation of strategy financial tools that are becoming available. And increasingly, most of these models are going to be having AI built in, and that would make the life of both the FP&A team as well as the senior management very helpful in making a quick decision when it comes to financial policy making. So in conclusion, the strategic financial planning is an ongoing process. It requires a continuous adaptation and refinement. And by aligning financial resources with the strategic priorities, the organization can really navigate the complexities of today's business landscape and achieve sustainable growth and secure the future. Thank you so much.
Okay. Thank you, Khalid Saab. It was fantastic illustration of financial concept. It is very difficult to understand for everybody, especially operations people, but you made it you made it more simpler. Okay, so there are so many questions posted. Unfortunately, we don't have much time left because it's the end of the day. So still
yes,
we have 2 sessions to be covered. Okay, so yeah. So one question I think for you is execution frameworks in Unilever and Novartis. In your experience, what kind of execution frameworks they have used? Yeah, just to
right. So in Unilever, they had a version of balanced scorecard, and they used to call it strategy into action. It was mainly the balanced scorecard framework, but they actually gave a separate name. It's the same. And in Novartis, they used a simplified balanced scorecard.
So it's a balanced scorecard in different names. People, you want to use their own name. Okay, so the concept is the same.
Yeah, they don't like the word scorecard.
Okay.
I'd just like to say one word. In Novartis, amazing alignment. So they had a new chief executive, and he came up with 5 business strategic priorities for the business, and it cascaded down to individual level, right from so all the plans, and including individual plans, had to reflect those 5 strategic priorities, which was around innovation and people and culture. So that is very important that when you are talking about strategy execution, it is important that the alignment has to be there. And we talked about this today in great depth. Alex, as well as the other speakers, showed the importance that when we are doing the strategy execution, it's so much important that we are actually aligned with the core strategy purpose.
Thank you, Khalid sir. Thank you very much for your time and patience. It's the end of the day, but still the energy is up in the conference, and because it's no 2 lectures are same, so it is very informative and helpful for everybody. Okay, yeah.
Thank you so much. Thank you.